In this video, we're going to look at the transactions which need to be adjusted in the final accounts. So on the screen, you see a trial balance. There are a range of account balances which are given, and there are 7 additional pieces of information. And these are the transactions which need to be adjusted in the final accounts. So we are now going to look at each of these transactions and discuss what is going to be the impact of these transactions on the final accounts, and how do we adjust for these transactions without writing the journal entry, ledger posting, and trial balance. So we're going to look at the first transaction, first additional piece of information. Closing stock has been identified to be 65,000. Some X number of units must be there. Let's say there are 100 units, an assumption. So there is a process which has to take place in order to count the closing stock. It's called the stock audit that happens, and the information comes out maybe much later after the trial balance has been prepared. So we know that the closing stock is the unsold stock. Closing stock is the unsold stock. And if this is the unsold stock, this must have been first of all purchased. In the purchase account, you have all the goods that are purchased, and some of these goods are sold, some of these goods are unsold. In the trial balance, in the trading account, in the trading and profit and loss account, and I write only trading account because I'm talking about the first section in the profit and loss account. In the trading account, we have to show the purchase. What is the amount of stock that was purchased during the year? Now, if this closing stock has been identified later, then in the trial balance, let me go back to the trial balance. In the trial balance, these are the purchases, 90,300. This is the purchase amount, 90,300. This is the purchase during the year. However, out of these purchases, 65,000 is unsold. You cannot show 90,300 as the purchases in the trading account. And also, in addition to purchases, you have opening stock as well, 60,500. 60,500. So actually, this is opening stock. So this comes out to be 800 and this. So 150,000 and 800 is the value of the total stock available during the year to be sold. Now, out of this, 65,000 has not been sold, and you cannot show this 65,000 as your expense. So you have to deduct it out of the total amount purchased. But this has not been done in the trial balance already. Therefore, we will need to make an adjustment. That is what is meant by adjustments to final accounts. So this 65,000 has to be taken out of the total purchases so that the correct amount of purchase is shown. Okay, so that is one. The other impact of the closing stock, this unsold stock, is going to be that this stock is available to be sold in the next year, and you expect to convert this stock into cash in next 1 year. So it is giving you temporary capacity to generate revenue. So this is a current asset for you as well. So in the balance sheet, under the current assets, you have to show unsold stock, or closing stock is more popular. So closing stock has to be shown, the amount being 65,000. So that is the adjustment you need to do. In the trading account, the way it is shown, and we've discussed this earlier as well, we don't sum this up, but in the trading account, what we do is on the opposite side, we show closing stock. Closing stock 65,000. This is as good as deducting it from the other side, but the conventions dictate that you write closing stock on the opposite side. So you should note that there are two adjustments that we are doing, number 1 and number 2. The first adjustment of a closing stock is to show it on the credit side of the trading account. Alright, this effect is happening in the income statement. The second adjustment is that you show under the current asset in the balance sheet. And this is the impact in the balance sheet. So what we learn from this is that for this adjustment, we did two adjustments. One adjustment in the profit and loss account, because profit and loss account includes both the trading account and profit and loss account, or we could say income statement. And the other impact is in the balance sheet. Just remember these two, and we will see if there is a trend as we move along with more transactions. So I hope this made sense. A closing stock has to be adjusted in the purchases and also in the current assets. Let's go to another transaction. So we have discussed this one transaction. Now we're going to do the second transaction, which is an additional interest on investment rupees 500 is yet to be received. It says additional, which means there must be an interest item in the trial balance. And here it is, 500 given on the credit side. This is an income. And now it says an additional interest on investment 500 is yet to be received. Now let me go to this slide here and discuss what this means. Okay, and additional interest means in addition to the existing 500 that you have in the trial balance. So this is an income during the year. Now in addition to this income, there is additional 500. There is additional 500 which is yet to be received, which means you have not received cash. However, accounting is done on accrual basis. So accrual basis, which means whether or not you have received cash. If you have earned the income, you have to show it in the given financial year. So have you earned the income? Well, clearly it is, the transaction mentions that it is yet to be received, and if it is to be received, it must have been earned. So we assume that this has been earned already, which means services have been delivered. This is interest on investment, which means the money was deposited in some scheme and you have to receive that interest. So you have earned this interest on the investment. So this is additional 500. So whatever has been earned has to be shown as the income. So instead of 500 in the profit and loss account, you have two sections. We are talking about the second section where you show the interest income. The interest income is 500, but we have to show an additional income, which is income earned but not received, also called accrued income. So here we will call it accrued interest. Accrued interest 500. So the income in this year is actually 1000. You have not received 500, but the total income should be shown as 1000. So the first adjustment that you need to do is to show this in the credit side of P&L account, right? And this is the impact on the income statement. The second impact of this is going to be, since this 500 is to be received, it is to be converted in cash. It is similar to the stock. Stock has to be converted into cash. So any item which is to be converted into cash within next 1 year is a current asset. It helps you add a temporary capacity to the business. So the other impact is that in the balance sheet under current asset, you will show an item called accrued interest, amount being only 500, because the rest 500 has been received. You will not get any cash for that amount because that is already done. This additional 500 goes to number one, the income statement, and number 2 in the balance sheet. So let me write here under the current asset in the balance sheet. Again, what we see, what we observe is that there are, just like we had in the previous case, you had two adjustments, one in the income statement and one in the balance sheet. So again, you have two adjustments, both in the income statement and the other one in the balance sheet. Okay, a trend is emerging for both the transactions that you have. You had two places where you needed to adjust, and one of the place was in income statement, the other one was in the balance sheet. Let's see what happens with the third transaction. Here is the third transaction. It says ₹1,000 of commission received. Is there a commission received? Well, here commission, credit side, it means it has been received. The adjustment says that we have now come to know that ₹1,000 out of this 3,000. ₹1,000 of the commission received is yet to be earned. Now this is exact opposite of the previous adjustment that we did. Here you have received the money, but you have not earned it. This is unearned revenue. So let me do a little bit more discussion here. So you have received 3,000. However, you have not earned, unearned. Unearned is 1,000. So 2,000 is the actual income according to the matching concept. The matching concept says incomes of this year to be matched to expenses of this year. We are talking about an income, the income of 3,000 which has been received. You have rendered services worth only 2,000 to, if this is a client, and 1,000 is yet to be earned. So unearned also can mean that this is an advance income which has been given to you. Okay, and you have the services to be delivered, services or goods to be delivered, and if you don't do that, then the other party has a claim on the business. They can recover this money from the business. So if you have not done your part, you have not earned the income. If you have not earned the income, you can't show it in the books of accounts as your income. So what should you show it as is the question. So the first impact is going to be that in the profit and loss account, you have commission, and I'm talking about the second section. You have commission 3,000. What you should do is you should deduct from this the advance commission, the unearned commission, which is 1,000, and in effect only show 2,000 as your actual income during this year. That is the first impact of this adjustment. The second impact of this adjustment is going to be in the balance sheet. In the balance sheet, this advance income actually, this unearned or advance income represents a liability which you'll have to meet in the next 1 year. You have to deliver goods or services against it. So the impact is going to be that under the current liabilities, you show advance income or unearned income, whichever name, it does not matter. Advance income, and you show amount 1,000 is the advance income. So the two impacts again are one of them is in the profit and loss account, the other one is in the balance sheet under the liability side under current liabilities. So two adjustments, one being in the profit and loss account, the other one being balance sheet. This is same as what we had for the last two transactions. So clearly a trend is emerging. Can we believe this to be true, that any adjustment goes to two places? There are two places where the adjustment needs to be made, and one of the place is in the profit and loss account, the other one is in the balance sheet. Well, let's look at few more transactions, and then if we see the trend, then we will come to this conclusion. Okay, next up we have rupees 500 insurance premium. uh, Paid is the in respect of the next year's first quarter. Okay, so the insurance premium, let me look for insurance premium. Fire insurance premium, is there any other premium? No. So fire insurance premium 2000, and it says rupees 500 of this amount. So out of 2000, rupees 500 has been paid for the next year. If you have paid something for the next year, you have paid in advance. So anything which has been paid for the next year should not be counted as the expense of this year. So we need to make an adjustment for this. Let me go to the relevant slide here. So the fire insurance that has been paid is amount 2000. And right now, if the adjustment is not made, we will show this full 2000 in the income statement, in the profit and loss account. We will show 2 insurance premium, let me just write it in short, and 2000. Now, according to this, the profit is going to be lower because actually the amount of 500, this is for next year. For next year, this is paid in advance. This is paid in advance, which is also called prepaid. Pre means before, in advance. So this is prepaid insurance. Prepaid insurance. And this prepaid insurance is not the expense of this year. So what you have to do is deduct from this 2000 the amount which is prepaid. So 500 has to be deducted and only 1500 should be shown in the income statement. That is the first adjustment that needs to be done. Now the other adjustment is going to be in the balance sheet again. So in the balance sheet, under the current assets, we are going to show prepaid insurance. Prepaid insurance, and the amount is going to be 500. Why are we showing this as a current asset? Because within the next 1 year, you are going to receive the benefit against it, and at that point in time, you will not have to pay for it. So it kind of saves cash for you. It does not bring in the cash, but it saves the cash, which is almost equivalent to bringing in cash in accounting. So the first impact is that we show it in the debit side of profit and loss account, and the second impact is that we show under the current assets in the balance sheet. In conclusion, you have two adjustments. One in profit and loss account, the other one in the balance sheet. Again, the trend is converting itself into a fact, into thing which can be true for the rest of transactions as well. So let me stop here. These are 4 transactions. I'm going to continue this discussion on the 3 more transactions in the next video.